In this video we're going to talk about the value at risk, its importance and the different methods used to calculate that metric. Imagine that you are sitting at the management board of a bank or fund. You would need, as a high-level decision maker, a summary of the situation without going through the details of the trading book, which would take you ages. That is where metrics and numbers like the value at risk are important to look at. They sum up at a high level what you need to know and allow you to take action quickly. They also give the regulators and the audit a great deal of information about the health of the bank. The value at risk, or simply called VAR, is a number that answers the question, what is the maximum loss that we could incur with a defined level of confidence during a defined time frame? There are different methods that can be used to compute the VAR. There is the historical VAR, which is widely used by the banks and which is the easiest method. It consists of taking historical returns of the deal's underlyings and computing the profit and loss called P&L based on those returns. This would give us a certain number of scenarios depending on the number of historical dates. So let's say we have 100 scenarios. The VAR 1% would be the worst P&L, since we would be looking for a value such that our P&L has a 99% chance to be greater or equal than that value. The downside of this method would be the fact that we rely on a limited number of historical returns, not taking into account extreme events that might occur. Second method is the parametric VAR, which takes a bit more computing power than the first. It consists of a fundamental hypothesis, which is that the underlying returns are normal, meaning they follow a Gaussian distribution. Using this strong hypothesis, one can simply extract the VAR mathematically, just knowing the mean and the variance of the distribution. In the case of a multitude of underlyings, which is the closest to reality, we would be computing the variance-covariance matrix in order to extract the VAR. The downside of the parametric method is its hypothesis. Clearly, when you look at the returns, they do not follow a Gaussian distribution in the real world, and hence this implies a simplification that has an impact on the final VAR number. Third and last method is the Monte Carlo method. This method is based on the simulation of the underlying values or returns by defining or choosing a density function or a probability distribution that the returns should follow. Then based on these simulations, we calculate the P&L using the polynomial approximation between the Greeks, delta, gamma, etc. and the P&L. The downside of this method is that it demands more computing power and hence takes more time. That's it. I might have disregarded more of the downsides and upsides of the different methods. That's because I decided to focus on what is important. I hope this has been useful.